Hey, Dan Passarelli here. Easy come, easy go, as they say, following yesterday's big update, which was actually the fifth biggest intraday reversal in the entire history of the S&P 500. We pulled back quite a bit, and we're basically just about back where we were Wednesday. Couldn't quite make it over that 20-day moving average in the SPY. Now, that said, I've been talking a lot about what to watch, and we all know that earnings is what we have to keep our eyes on right now. The most important thing for the next 2 weeks, 2 to 3 weeks for sure. So that said, I was thinking about what to talk about today, and I was talking about this recently, just today actually, with someone about trading small accounts. And I want to give you a little tip here. So let's imagine that you have an account that has less than $25,000 in it. Now, if you have less than $25,000 in it, your broker's not going to let you day trade. That means if you put a trade on today, you can't close it. Not for a profit, not for a loss, not for anything. And if you do, they put you in, brokerage jail, and they don't let you trade for a long period of time. It's a bad problem. You don't want to have that problem. So what if I put on, let's say, a credit spread, okay? And here, let's take a look here at just a random example here. Let's say I sell these SPY 360, 361 call credit spreads, right? $10 wide spread. I sell it at 46 cents, and I end up with a credit spread on. Okay, great. Now imagine we get another one of those crazy days like Thursday, and 2 hours after I put it on, the S&P 500 blasts through 360, 361, 362, and it's trading like $2 ahead, above it. And you're looking at a situation where, oh man, I better get out of this so that I take a small loss instead of have it turn into the maximum loss, right? We've all probably been there before, or at least if you've traded for a long time, you have. So is there anything you can do if you're not allowed to close the trade? And that answer is yes. So when you have sold a call credit spread, the one thing that you can do to get out of almost all the risk is to adjust it into a box. A box is a four-legged spread, and it's basically a call credit spread and a put credit spread. So basically negative delta on the call side, positive delta on the put side. So what we would do is, if I were short the 360 calls and long the 361 calls, all I would do is I would short the 361 puts and get long the 360 puts. So basically, I'd be short the 360 calls, long the 360 puts, long the 361 calls, short the 361 puts. Now, what the heck does that really get you? Well, what it does is, this is an exercise in synthetics. You hear John and I talk about synthetics every now and then. We talk about how important they are, but they seem really esoteric and theoretical, but they can really come and save your butt sometimes. In this situation specifically, when we think about it synthetically, we can think about it a number of different ways. Those of you who are in my Trade Smart workshop, the online education series on Thursday, have seen this in the vertical spread series and a couple other series where I talk about synthetics. A call credit spread is synthetically equivalent to a put debit spread. If we're short the 360 calls, long the 361 calls, if we instead were short the 360 puts and long the 361 puts, so basically the opposite of what I was saying in constructing the box, we would have similar profit or loss on either of those trades. It's a synthetic relationship. Now, another way to think about this synthetically is that if we're short the 360 calls and long the 360 puts, that's synthetic short stock. If we're long the 361 calls and short the 361 puts, that's synthetic long stock. So we're short stock at 360, long stock at 361. That has a value of $1, right? That box would simply be worth $1. If we simply reverse the trade by doing the opposite strikes, buying and selling the opposite strikes on the put side, that rolls us into a box and it takes off almost all of our risk. Now, there are some risks with early exercise with boxes. And we would only want to use this if we have to. We don't like getting fancy for the sake of getting fancy. And we also would only want to use this when there are nice, tight liquid markets where I can trade pretty much mid-market. And when you do, this can be a nice little tool in your tool belt. And then the next day, when you're able to take that trade off, then you can simply take off the box for, in this case, it would be worth $1. And you could just put in your dollar bidder offer, as it were, and trade out of your box. Now, what I mentioned before and what I mentioned yesterday, and holy moly, even probably the day before, is that this earnings season is super important. I don't recall ever seeing an earnings season this important. And so I have a class tomorrow morning. I'm getting up bright and early. I'm going to do a live online training all on trading earnings, and you should attend. So simply go to the webpage that pops up right after this, get your complimentary registration, and I will see you tomorrow morning with your cup of coffee in hand, ready to dominate earnings this earnings season. I hope that helps. This is Dan Passarelli. Have a great weekend and trade smart. I'll see you tomorrow morning.